right, we are joined now by the Treasury Secretary, Scott Bessent, just off stage here at the Milken Conference. Such a pleasure having you.
Morning.
So if I had to distill your message just now is the time to invest in America. Is that what you're telling investors, and why now?
Well, the message is that the economic program is a three-part stool. Everyone's focused on trade, but there's trade, there's tax, and there's dereg. You were talking about it earlier.
Yeah,
the three prongs, and you shouldn't look at them in isolation. So what we are trying to do, the U.S. is the best place to invest, and we're trying to accelerate that.
As far as the tax deal, I know you're knee-deep in that, as you are in some of the trade negotiations. How do you think about the growth impact? Because some people say, oh, it's just an extension of what we have now, so we're not going to see a big stimulus.
Well, what's not an extension is the 100% expensing. So that has stepped down over the past few years. So we're going to go back to 100% expensing for equipment. And then a new aspect is we're adding 100% expensing for the actual factory structure. So I think that 100% expensing for equipment, 100% expensing for structures, along with tax certainty, and then the lower energy cost and dereg will really accelerate the economy. And the other thing too is, like, permanence is a stimulant. So so the uncertainty goes away, and we are going to make the 2017 Tax Cuts and Job Act permanent. So there will be the stimulus from the permanence.
How are you thinking about offsets? I know there's tariff revenue coming in, but the hope is as you get deals done on trade, ultimately there will be less of that.
Right. So, what you mean offsets for the stimulus?
For paying for the tax.
I mean, that's what a big part of the DOGE effort has been, fighting waste, fraud, and abuse, and we found substantial areas for cuts, for greater government efficiency, and look, I think both the House and the Senate are looking for substantial savings.
Right. Ultimately, I guess the question is, what is the expectation? You tell your former fellow colleagues and investors here at Milken, they're wondering deficit projections. We've seen what's been happening with DOGE. Clearly, you're talking up the tax cuts. What should be the correct expectations for the deficit? Well,
look, I think, and when I look in the mirror, I see a deficit hawk. And I tell a lot of the very eager senators and the members of Congress who want to do all the cuts this year, but let's just step back for a moment. That every $300 billion is 1% of GDP. So if you want to cut $1 trillion this year, we can do it. But that's a 3% shock to GDP. The way to do it smartly, we're talking about bringing the deficit down by about 100 basis points every year for 4 years, get us back to the long-term average of 3.5%. And then a big cure for the deficit is upward growth shock. So CBO scoring is at 1.7 or 1.8% growth, no matter whether you have a tax cut or a tax hike. So we think that through deregulation, the permanence of the tax bill, we can get growth closer to something that looks like 3%.
By end of year?
By this time next year.
Where's the growth going to come from? You mentioned taxes. On deregulation, what sectors do you think are going to feel it the most, and we're going to see the most stimulative impact on the economy?
Well, what I've been talking about is reprivatizing the economy. So on one side, we're going to be bringing down government spending, which has been crowding out the private sector. We're also going to be shedding excess labor on the government side. Then on the other side, we have a substantial financial deregulatory agenda coming from, we put a lot of new regulators in place so the private sector can re-leverage, and we're putting a special focus on community banks, small banks, small regional banks, which were very near what I would call an extinction event in the next 4 or 5 years. So the idea is to get them lending again too.
At the same time, we do still have this uncertainty factor around what's happening with trade. And I'm sure you hear that all the time from investors and from CEOs. How's it going on the negotiations, and when do you think we'll start to see some deals?
I think we're very close to some deals. As President Trump said last night on Air Force One, maybe as early as this week. So when you think about uncertainty, uncertainty, a lot of it is generated by, I have asymmetric knowledge, so I'm not uncertain because I think it's going well. Other people don't know what I know. So
you have to share that with us then.
Well, I can say that I am highly confident that we have 18 important trading partners. We'll put China to the side. The 17 other partners, many of them have approached us with the very good trade proposals. President Trump is going to be involved in all of those. He will be the final decision maker, and we'll see where that goes. But I think that at the end of this, even if we have tariffs still in place, because the non-tariff trade barriers are coming down, because we could see an end to some of the currency manipulation, the unfair subsidy of labor and capital from the other countries, we could see the more frictionless trade.
Ultimately, that's the goal.
Well, the goal is twofold. The goal is to open the foreign markets and then bring back manufacturing to the U.S. And we're thinking about that in two ways. One is there's strategic industries. So during COVID, we saw that there were many strategic industries where the U.S. was woefully deficient, whether it was medicine supply chains, in chips, in steel, that many of the overseas suppliers were just unreliable partners. So we can't have that happen again. And then on the other side, we want to bring back manufacturing and rebalance the economy.
But China is key. I know you set it aside, and you're heavily involved here. You have said they need to de-escalate and start that process for us to get going on trade talks. Have they made any effort at this point?
I think we could see substantial progress in the coming weeks. We'll see. That I think it's Stein's law, that which is not sustainable doesn't continue. So 145%, 125% tariff levels are the equivalent of an embargo.
Yep.
And we're reading every day what's happening with factories in China. And from an academic point of view, I can tell you that the history of trade battles, we are the deficit country. The surplus country always has the most to lose.
So they need to make more gestures. What is it that you're looking for, and is that happening? Is there a negotiation about the negotiation?
Yeah, we'll see over the coming weeks, and we'll see what President Trump wants to accept.
Right. I mean, have they offered anything on the fentanyl, for instance, precursor ingredients?
Only what they have said publicly. So, and I can tell you that these precursor fentanyl drugs are real. There are a lot of Chinese companies. At Treasury, we have the ability to do a lot of financial surveillance, and we see Chinese corporates that are linked with the Mexican cartels, and that's got to stop. That's going to stop. Like, what is the price for these hundreds of thousands of fentanyl deaths that we have, the families that are left behind, and then the lives that are ruined?
Right. So when you were on a few weeks ago, we gave you a lot of grief when the market was tumbling. We saw this sharp sell-off. Now we've seen a pretty historic comeback with 9 straight up days, erasing all of the losses from the post-Liberation Day declines in the stock market. I'm wondering what you make of the rally, and also the fact that the 10-year yield, which I know you watch more carefully, still remains a little elevated here around 4.35.
Well, I mean, look, it remains elevated. It's down from January 1. It's down from January 20th. right before Liberation Day, about 3 weeks ago. It was at 390. So what you're saying is it's elevated from 390, and everyone's saying, oh, well, Secretary Bessent got what he wanted. 10 years at 390, but it's there for the wrong reason. It's because it's pricing in a recession. So what are we pricing in now? Are we pricing in better growth? That I'm just focused on the right economic policies, bringing inflation down. So I prefer not to talk about the market. Sometimes when it's volatile, I get called upon. But we came out of the gate on January 20th with two goals: getting interest rates down, 10 years lower, mortgage spreads are compressed, and getting energy prices lower. And energy prices are substantially lower.
Why should people not worry about stagflation? I know energy prices are lower, but there's a little bit of concern. We saw it in prices paid, services numbers today, with the tariffs coming on, that we will see flare-up of inflation at a slower growth moment. Well,
if I look at the Fed's favorite measure of forward inflation, 1 year forward, the 5 year, both of those are down on the year. So the inflation the market isn't pricing in inflation. And then there's nothing, I haven't seen anything, there's survey data that talks about a slowdown, but the hard data continues to be resilient.
Yep, saw it in jobs, saw it in services. Secretary Bessent, thank you for your time today.
Good to see you.
In the familiar place for you here at the Milken Conference. That is the Treasury Secretary, Scott Bessent, Carl, on why he's talking up the growth prospects for second half and in the coming years.
Yep, looking for market reaction to that. S&P still a little bit south of the flat line. And Dow has gone up about 68 points as Wade Palantir and forward earnings after the bet. Let's get to the judge.
Okay, thank you very much, and welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, streaking stocks. The S&P going for 10 up days in a row. Obviously have a little bit of work to do today to extend that run. We'll ask our experts how to play the markets from here. And we'll also be joined in just a little bit from Altimeter's Brad Gerstner from Milken in Beverly Hills, and we look forward to that. Joining me for the hour, Joe Terranova, Jim Lebenthal, Anastasia Amoroso, Brian Belsky. We'll show you what we're doing in the markets here. Dow's green. As I said, we do have some red on the board. S&P is down by 1/3 of 1%. NASDAQ's about 1/2. We might as well start with what the Treasury Secretary had to say. Obviously, we were watching the markets closely there, Joe, when Scott Bessent was talking to Sarah. We're very close to some deals, he said, related to trade, maybe some as early as this week. On China, I think we can see substantial progress in the coming weeks. We'll see. Didn't really want to talk about the market, as he made perfectly clear, but trying to remain as optimistic as certainly he can about where growth prospects are. Doesn't sound in any way that he thinks we're going to have a recession. What's your take on the rally that we've had? We're going for 10 in a row, and then in the context of what Secretary Bessent just told Sarah.
I think his words are always pro-market. I think his words always give investors comfort. And I think his emphasis on where are yields, where is the price of oil, really underscores what the clear intention has been on this three-prong approach to fiscal policy. I understand the sequencing was difficult for markets to digest. That was a very aggressive tariff policy. But markets have clearly recovered. And when you ask the question, what do you think about as it relates to markets as we move forward, what's interesting to me is always trying to discover what the personality of the market looks like. And I think what's very clear in 2025 is that the opportunities that we are seeing are no longer just isolated to software, semiconductors, artificial intelligence, halo names. We're actually seeing areas of the market like financials, like industrials, that are providing strong earnings growth and therefore strong price appreciation. And if there's one thing I can emphasize to the viewers, it's not figuring out exactly where the market is going, not trying to figure out are we going up and down, but rather ultimately where you want to be. And in 2025, the one element of investing that we have restored is being able to diversify once again, because you actually get paid to own financials, industrials, and healthcare.
We moved up a little bit, just a little bit, on perhaps what the Treasury Secretary had to say to our Sarah Eisen there. Again, optimistic that we could get some kind of trade deals as early as this week. As I was saying a little bit earlier, I think we can see substantial progress in the coming weeks. Brian Belsky, Joe makes the point, he said the markets, they've recovered. Yes, they have, but I still don't feel as though the great majority thinks we're out of the woods, because there are a lot of issues to still be decided. As Apollo's Mark Rowan told David Faber earlier this morning, the uncertainty has, in his words, ground things to a halt.
I don't know what's been grounded to the halt. Stocks have been pretty positive for the last couple of weeks, and I think Joe's most apropos comment, quite frankly, was about stop trying to pick the market and start looking and appreciating the diversification and the broad participation that we've seen. As you know, we've been long-term bulls. We've been long-term bulls in financials, and there's other areas of the market, as Joe said, in terms of where we're seeing some earnings growth, some healthcare, but mostly industrial and even some consumer. And oh yeah, by the way, big cap tech and communication services are doing quite well too. So I do believe that the longer term trend of normalization is upon us. I do believe that means that you're going to want to own some large, some small, some value, some growth, and be much more evenly distributed with respect to your equity investments. But I do believe that the recovery is real. This is not a dead cat bounce, and I think stocks are going to be higher as we continue to go forward.
Anastasia, what about you? Do you think we're far from out of the woods? Brian Belsky, I mean, he's kind of always bullish, so hearing him say that he's bullish today doesn't really shock me. What about you?
I do also think, Scott, that the recent positive momentum can actually continue. And, first of all, on this point that so much demand has been pulled forward, and this is why we have the strong economic data while an activity is likely to grind to the halt. That's what people think, but what the market really care about is two things. What is happening with trade deals and what is happening with tax policy? And as we just heard from Secretary Bessent, it seems like both are progressing quite nicely. So on the trade deal front first of all, I do think we have seen peak tariffs, and it seems like the administration is really committed to getting some of these deals done before the July 2nd or so deadline. So that means that even if we go through this quarter, the second quarter of uncertainty, and the short-term pain is going to be mitigated by the fact that when July comes upon us, we will likely have a deal in place. So I think that's quite favorable. The second thing that's quite favorable is that this is still sort of behind the scenes, but Congress is working on tax policy. And one thing Secretary Bessent was emphasizing, that they want the United States to continue to be a great place to invest. And that means not only personal tax rates, which will be continue to be extended, but also on the business side, maybe there will be some accelerated depreciation, maybe there will be interest deductions, maybe there will be R&D expensing. So if you make this an attractive place to invest, the capital will continue to come here. So overall, Scott, I would say the administration's approach has been short-term pain, which seems to be focused in the second quarter for long-term gain. And I think we're starting to sense some of that optimism about the long-term gain. So I do think the market momentum here can continue. And by the way, the technicals are also much more supportive of it coming into May.
Jim, maybe Belsky's bullishness is well-founded if you look at the three-pronged approach that the Secretary believes that the administration's taking. Tariffs are but one. Taxes and deregulation are the other two outweighing the one. And especially if you think we're going to get some trade deals, which we are eventually, obviously, we can dissect them at the time. But the tariffs to this level today are not going to be at this level figuratively tomorrow, right? So what about that?
Well, I like running with Brian on this, and I think when you get to the end of the year, if all the things you just laid out, Scott, come true, we're going to be nicely higher in the markets than we are now. I do have to respect, just as a market participant, that we've been up 9 days in a row on the S&P 500, first time in 20 years. Scott, if we get a 10th day today, that's the first time in 30 years. I don't know if it's ever happened 11 days in a row. Somebody will probably tweet it in. The point I'm driving at with that is a lot of good news is priced in. A lot of what you just said, deregulation, and Anastasia said it as well, deregulation, lower taxes, and some trade deals. Okay, that's good. A lot of that's priced in, and as a market participant, I'm looking at the last 2 weeks of gains and saying, all right, I'm going to trim a few winners here and not put that money immediately back to work. I'm not making a huge market bet here, but I am taking a little bit of money out of the market so that if there's some dislocation on who knows what. You know, yesterday we had President Trump talking about 100% tariffs on movies filmed overseas, and that knocked Netflix down, albeit it's recovered. My point being is that there is going to be volatility going forward. A lot of good news is priced in. It's probably going to come true, but there will be volatility and buying opportunities. I want to have the dry powder ready.
How is that priced in? How are taxes and deregulation possibly priced in? Okay. We haven't even recovered all the losses from the trade upset.
We have. On the S&P 500, yes,
I mean, we're still down. Let's just say we're still down year to date. We're still down year to date. All right, let's just say that. How are taxes and deregulation priced in?
Well, because first off, okay, good question. You know, first off,
it's the question, according to your answer.
He always asks good questions. I know. Anybody read the Beige Book last week? I mean, those anecdotes from manufacturers. Okay, that's good reading.
Seriously.
Those anecdotes from manufacturers were pretty dire. And they were talking about things like they're not getting orders because of the higher prices they're pushing through, the higher prices of raw materials. They're thinking about laying people off. They're not making profits. Okay, so there is some bad news out there that this market is looking past and pricing in my opinion. They don't write this in the lead of the Wall Street Journal. It's being looked past by virtue of deregulation and lower taxes. And I'll also point this out. Deregulation and lower taxes are not a fait accompli. There is a lot of dissension, particularly on taxes, in the Republican caucus that needs to be worked out. So when we're up 14% on the S&P 500 from the low, I would say there's quite a bit priced in that's good.
Yeah, I think to play the other side here, and I think to Scott's comment before about things grinding to a halt, I have had conversations in the last several days with several people, one of which is a very big real estate developer here in New York, who has said, we are just seeing frozen commerce.
Everybody knows that business activity has slowed dramatically. CEO decision-making has slowed dramatically. The uncertainty has done that. We're not talking about the stock market activity, but Mark Rowan sees and talks to a lot of business owners in a lot of areas of not only this country, but around the world, and talks to leaders as such. So he echoes what almost every other person has said. I don't know, we can get back to Belsky for a second, like trying to throw cold water on that notion. But you give me your answer, please.
No, I just think that the stock market sometimes is not the economy, and sometimes the economy is not the stock market. And I really do believe the economy continues to cool. I think the effective damage from the aggressive tariffs is already built into the economy. I'm not sure exactly how you give people comfort to go out and say, okay, we're going to begin to accelerate spending once again, either for consumers or for corporations. So to me, that leads to an environment where at some point the Federal Reserve has to do something, maybe the NQT. I look at the bond market. Okay, we talk about being up 8 or 9 consecutive days. The bond market has allowed that. Remember that. If the bond market, if the 10-year starts going back towards 4.50, we're not sitting here talking about the equity market going higher. The bond market is running the show, and equities will roll over if, in fact, that happens.
Bond yields have started to move higher towards the end of the week. Now, a better-than-expected employment report would obviously do the trick on that. Belsky, I'll give you the last word on this, because your portfolio moves very much represent your perspective and your point of view. You are leaning in a little bit more to the consumer. You bought Deckers, you bought American Eagle, you bought more Target, you bought more AMD in terms of tech. So you are putting your money where your mouth is, so to speak.
Thank you. Yeah, well, my good friend Stephanie Link's been trying to get me to buy DEC for a long time, and the stock's down 40+% this year, but operating income remains quite strong. And on American Eagle, we've got some great brands there, but this is another area that has been absolutely hammered. We like to be value investors when everyone else is saying the opposite, and so at the end of the day, a lot of our work is centered around estimate revisions, Scott, and estimate revisions for the out year, meaning FY2 for 2026, have been hammered for the S&P 500, but even worse so for consumer discretionary. And going way back over the last 20 years or so, we've always bought the consumer when everybody hates it. So I don't doubt that things have slowed down. I get that. But from a longer-term perspective, these names have been absolutely beaten up. And given my prior comments that I think we want to own, quite frankly, some value and some growth, we need to be opportunistic in some of these areas that have been beaten up.
All right. Let's bring in our halftime headliner now. He is Brad Gerstner. He's the founder and CEO of Altimeter Capital. He's live with us